Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from the OECD's Pillar 2 to U.S. tax developments. I'm Doug McHoney, PwC's International Tax Services Global Leader. Check out PwC's Policy on Demand news platform that provides in-depth insights and analysis on tax policy developments. Policy on Demand is now available for free at policyondemand.pwc.com. On this week's episode of Cross-Border Tax Talks, we're back in our Policy on Demand studio in Washington, D.C., where I'm excited to be joined by Jason Black. Jason is a partner in the Federal Tax Services Group of PwC's Washington National Tax Services practice. Jason, welcome to the podcast. It's great to have you on.
Happy to be here.
All right, so Jason, before we dive into the corporate alternative minimum tax, formerly known as the book minimum tax, there's been a lot of press recently about the lack of accounting majors and yet a very high demand for them in the market. You have an accounting degree and a master's from the University of Florida. Want to give a shout out to Gary McGill. Jason, what do you enjoy about your job and what would you tell someone considering an accounting major?
Go Gators, by the way. So I would probably say that what I like about my job the most is that it is constantly changing. I've been with the firm for over 14 years. I have been in multiple different roles within the firm. And I'd say like basically every day that I come to the office, I don't have a set agenda for what I'm going to be doing that day. And that's pretty exciting to me on a day-to-day basis because I don't like as much of the structure of around my schedule. So I do think learning something new every day, having the ability to kind of solve difficult problems with our clients is really helpful.
Yeah, and the other thing that I would mention, and maybe this is a good transition to the CAMT here, is that I have an accounting undergrad, went to law school, frankly kind of thought that I would get away from accounting was one of the reasons that I went to law school, and then I've been at the firm for almost 25 years in this point. And one of the things that's fascinating to me is now how we're going to be talking about this corporate alternative minimum tax, and I've spent a lot of time thinking about Pillar 2. We're now back to financial statements, right, as the basis now for these taxes. And I frankly have been cracking open my accounting textbooks. And so I think it's very fascinating. I love learning new things. The fact that we're in a very dynamic practice area really resonates with me because no days within my 25-year career have been the same. Mm-hmm. And I think it's important for people to recognize, particularly that are early in their careers, that are early in their education process, thinking about their careers, that there's just going to continue to be a huge demand for accounting. I think one of the challenges that we have as a profession is this 150-hour requirement, but it seems like the tides may be turning in that, and I certainly think that could potentially help the profession.
Absolutely.
So, all right, so let's get into the material. In August of 2022, the president signed into law the Inflation Reduction Act, which enacted, despite my best efforts to try to refer to this thing as the book minimum tax, a corporate alternative minimum tax based on adjusted financial statement income of applicable corporations. Obviously, all of those are defined terms. The CAMT, as it is now known, is effective for tax years beginning after December 31st, 2022. I would encourage listeners interested in the topic for additional background to check out my podcast from August of last year called The IRA and Book Minimum Tax, Not a Pillar 2 Podcast. So Jason, before we talk about the notice, can you remind listeners what is the CAMT and who's subject to it?
Absolutely. And some might remember back to pre-TCJA days when there was a corporate alternative minimum tax.
Right.
It got struck as part of that bill, and now it's back. It's enacted under the exact same code section as old corporate alternative minimum tax was enacted. So this is a 15% minimum tax based on book income, effectively book income. It's adjusted financial statement income, which is net income from an applicable financial statement, generally going to be your audited financial statement if you're public 10K. And then you make a variety of adjustments. There's about 12 to 15 under the statute that you have to adjust your net income to. Multiply that by 15%, and that's your tentative minimum tax. Mm-hmm. From there, you reduce that by regular income tax and BEAT. And if you have a positive amount, you pay corporate alternative minimum tax. what's good to know is that this is intended to be a temporary tax.
Right.
So you are afforded a credit when you do pay it in any given year. You are afforded a credit. We have seen some taxpayers that are just going to be perpetual kind of CAMT payers, that those credits might get usable at some point, but by the time they do, it's not going to have as much benefit to them at that point.
Which obviously has its own financial statement implications
Yes.
for those public companies.
Exactly. Right. So companies are definitely thinking about, what is the realizability of these credits if I am generating them.
The other important thing to note, and I think we'll come back to this a little bit later in the podcast, but I will remind taxpayers that could fall within this, that will be able to use those future credits, that I think it would be tenuous to argue that those would be good, qualified, refundable tax credits under the Pillar 2 rules. So if a U.S. taxpayer was using those credits in a future period where they were potentially subject to an income inclusion rule or under tax profit rule, that could cause them to fall into the Pillar 2 soup. And Jason, I'm already going to apologize that we're not even 5 minutes in and I already mentioned Pillar 2, but because this is not supposed to be a Pillar 2 podcast. But I think it is important for taxpayers to note, both inbound and outbound, that is an important issue for taxpayers to be mindful of.
That's right. Yeah, so it's not, and important to note, you did note that it's applicable corporation. So what is an applicable corporation? It's corporations other than RICs, REITs, and S-corps. So just like if you're familiar with the BEAT rules, similar exclusion for those types of corporations. So it's only going to be those types of corporations that meet what's a 3-year average annual AFSI test. So this law comes into effect for 2023. Calendar year taxpayers are going to look at their AFSI from 2022, 2021, and 20, and take a 3-year average. And if that exceeds $1 billion, they are going to be considered an applicable corporation. I will note that that's for normal, publicly traded U.S. corporation. If you're an inbound, foreign parented multinational group, as the statute defines it, and that's typically just a entity that is parented by a foreign corporation. Right. There is a 2-prong test. It's one, you look at the financial statement income of the entire foreign parented multinational group, and then separately you kind of look below the foreign corp. And so that first test is $1 billion on the financial statement of the whole group. And then you kind of look below the foreign parent, and is that above $100 million just on that basis alone? And there's various adjustments that you make to net income to get to those numbers, which are probably we probably won't get into a lot of those here, but just to know that there's a separate kind of test for foreign parented multinational groups.
Yeah, and I think the other thing that's important is that it's net income. Right, this is profit, or an approximation with these adjustments of net income. And I think some of the confusion, and again, I'm going to raise with Pillar 2, the Pillar 2 thresholds are top line revenue, right, for you to fall into the potential Pillar 2 soup, and that's at 750 million euro top line revenue. This, I think we've been calling the AFSI really is analogous to net income or profit. So it's a much higher threshold. Right, for taxpayers to potentially be subject to the CAMT.
That's right. Yeah, and important, kind of determining whether you're an applicable corporation is it's really important, because once you are an applicable corporation, the rules don't contemplate ever not becoming an applicable corporation.
Once you're in the soup, you're in the soup.
Once you're in the soup, you're in the soup. Of course, I think we'll talk about this, but there is deference to Treasury to write rules to get you out of the soup once you're in. So far, we don't have anything that tells us that, but generally you're going to be in. Once you're in, you're in. Right. And then once you're in, you compute AFSI for purposes of paying the tax. So everybody that's kind of close to the $1 billion test should be computing for 2023 their AFSI to see if they're going to be an applicable corp, and then if they are, do they have a liability?
Right.
Under the regime.
All right. Well, the statute, and you already alluded to this, but in my view, provided unprecedented deference to Treasury to sort out the details of these rules. And so on December 27th, 2022, 4 days before the effective date of the rules, Treasury released Notice 2023-7, providing interim guidance on the CAMT. In summary, and then we'll break some of this down, we'll double click on this, as we like to say, what did the notice cover?
So it covered I'd say 4 key kind of broad topics. It covered what to do with certain types of entities. I think it dealt with transactional related, M&A transactional related guidance with corporations. That's probably, and dealing with troubled corporations and how to treat cancellation of debt income. So that's kind of the first section of the notice, and it's very meaty. And I think that was in response to, I think there were numerous comment letters that said, we're undergoing actual transactions, and we need to know whether and how this is going to impact our liability under CAMT. Next, dealt with depreciation. There's a number of different issues about how you compute depreciation. There's for purposes of CAMT. We haven't touched into all of the adjustments, but there is a special adjustment intended to be a taxpayer favorable adjustment where you take your net income from your financial statements and adjust it basically to give you credit for tax depreciation, accelerated tax depreciation. There's a safe harbor also that taxpayers can use to determine whether or not they are going to be an applicable corporation for the first taxable year in which they're subject. And then finally...
We all love safe harbors.
Safe harbors.
Safe harbors are good, generally.
Yes.
Yeah.
This one, maybe not as helpful as we would have liked, but it's safe harbor nonetheless. And then finally, how to treat certain foreign, certain federal income tax credits that were created under both the CHIPS Act and the Inflation Reduction Act.
Okay. What didn't it cover? Because there's a pretty long list, right?
Yeah, there's a pretty long list, and I'll say it covered nothing from an international perspective. Yeah. So there are some key issues from an international perspective. I think you could talk about those better than I can. But there are some key international issues that it didn't cover. I think it didn't cover kind of treatment of mark-to-market on financial statements and how to deal with that. And it didn't tell you how to not be an applicable corporation once you are. There's about 3 pages of requested comments at the end of the notice. So Treasury's actively working, but they felt that this is the most important stuff.
I will acknowledge this is a big lift for Treasury, right?
Yes.
Because of the unprecedented deference given. This is a big lift for Treasury.
Yeah, they were busy, and they got a lot of comment letters, and I think they did a really good job on uncovering kind of the key issues so far.
All right, so let's start with the safe harbor because everybody likes a good safe harbor to be able to potentially try to simplify things. How do those rules work?
Yep, so this is a safe harbor that only works for one taxable year. It's intended to only work for the first year in which corporations are subject or potentially subject to CAMT, so calendar year 2023. What it does is takes those $1 billion thresholds and that $100 million threshold I talked about for foreign parented multinational groups, it just cuts them in half. So instead of having, for the normal domestic parented group, it's normally a 3-year average of $1 billion over 3 years. They cut it down to $500 million over 3 years. So definitely helps. And in making that determination, a lot of the 12 to 15 adjustments that are in the statute are ignored. Some are still taken into account, but largely most of them are ignored for purposes of computing AFSI. And then on the foreign parented multinational group test, the 2-prong test did the exact same thing. Cut the $1 billion down to $500 million and cut the $100 million down to $50 million. So I think it's helpful. I'm not sure how many people will fall into the safe harbor given how substantive the cut is from the normal test.
It's meaningful.
Yeah. So it's, but I think it does give someone at least an out to
give them a
not
year.
Have to look at it. Yeah.
Right. Give them a year. But presumably you obviously still need to be able to the extent that you're publicly traded, the financial statement auditors, and then but get ready because the next year you're still going to have to do the math and deal with kind of this opening balance sheet challenge for the CAMT that we're going to get into here.
And for some taxpayers, it's going to be, they're going to go through the kind of mechanics of the safe harbor. They're going to fail the safe harbor, and then going to have to go do the second test to see if they cover the $1 billion. So it's actually adding potentially an extra step for people once they fail the safe harbor.
Right. And for those that listened to my last podcast on Pillar 2, where we discussed the safe harbors with the country-by-country report, very similar type of issues. And I will remind listeners again that this is not a Pillar 2 podcast, but very kind of, it's amazing to me kind of the similarities, yet we'll talk about this is not, the CAMT is not a Pillar 2 IR, qualifying IR. So let's talk about kind of one of the other big pieces of the notice was some adjustments for depreciation. And maybe we start with cost of goods sold.
Yep. So I think I'll level set with the kind of what the normal adjustment says. And it's kind of going to be a little in the code here, but the rules basically say when computing depreciation for purposes of AFSI, what you do is reverse all of the depreciation expense that's running through your books, and then layer in, as a subtraction, tax depreciation, effectively. Tax depreciation under Section 167 for property that's subject to 168. So that's maker's property. That's your normal stuff that's typically eligible for bonus. What the statute didn't say is that, and this is super kind of nuanced, like ivory tower type stuff. And if for those that are familiar with the 163J rules,
which is the interest limitation rules.
Yes, the interest limitation rules.
Many of our listeners are.
Yes, people will hearken back to something that was in that statute. So the statute under enacting CAMT says it's, for tax purposes, it's depreciation deductions allowed. And allowed means like a really specific thing in the tax code. It means the things that you're actually deducting on your return.
Allowable, allowed.
Yeah, allowed. Allowable is what you're permitted to deduct. Right. Allowed is what you do deduct. So what's nuances here is that back to 163J, interest limitation, that statute said deductions for depreciation allowable. And quickly, practitioners pointed out, well, if my depreciation's running through cost of goods sold because it was capitalized to my inventory, that's not a deduction. That's a reduction to gross receipts or gross income under Section 61. So the statute was identical or very similar. So the first thing that came in was, Treasury clarified that when we said depreciation deductions allowed, we meant stuff that reduces taxable income. Okay. So you get to reduce your book or reduce AFSI by both depreciation deductions allowed and depreciation running through as cost of goods sold. But the key difference here is that under 163J, Treasury said, we don't care if some of that depreciation is still sitting in ending inventory. We're going to let you take it all as a subtraction for ATI purposes. Here, they did cap it at just the amount of depreciation that has run through cost of goods sold. So if you think about it, if I have $100 of depreciation capitalized to inventory, and I disposed of 90% of my inventory, $90 went through cost of goods sold, but that $10 is left sitting in ending inventory.
Right.
That's going to be an adjustment next year when this inventory is sold.
So, I mean, what this means is that companies are going to have to create this separate set of books, right, in addition to their GAAP and tax and Pillar 2 and now CAMT for those that are anywhere close to those revenue thresholds to now track these differences.
Yeah, it's and I think maybe, I think there will be commentary on this, and I think IRS and Treasury did ask for comments on this specific rule, like how are you going to deal with how are you going to determine what's actually run through cost of goods sold? Right. So they understand it's not going to be a simple task, but what I found sometimes is when there's favorable rules, they feel as though taxpayers will work out a way to comply with a favorable rule.
Right. So what about transition? I know that was the transition rules, and how far back do taxpayers need to go on some of this depreciation issues?
Yeah, that was requested by a lot of people trying to clarify how far back do I need to look to compute this depreciation adjustment. Can I just look at assets that were placed in service on or after 1/1/2023? IRS and Treasury clarified, no. It goes all the way back. So if you have assets placed in service in 2015 that are still being depreciated for book, maybe even just book purposes, that would go into your adjustment. So there is no cutoff date for purposes of computing this adjustment.
Right. So taxpayers need to get started
Yes.
in getting that kind
Yeah.
of the CAMT opening balance sheet established. All right, what about issues on disposition of assets before these rules were in place, particularly with respect to bonus depreciation?
Yeah, so I think in addition, the statute didn't provide for a rule on how to deal with dispositions of depreciable property. So they gave a rule kind of over the lifetime of the asset, how to deal with adjustments, but they didn't say anything about dispositions. Again, harken back to the 163J rules. They also had a rule for subtraction, in addition for depreciation deductions, and then a subtraction when you sold the asset for the gain. Similar here, when you dispose of the assets, you have to recompute your AFSI basis in the asset. So you do have to have an adjustment on the back end when you dispose of assets. All of these adjustments are really getting at just reverse your book depreciation and get back to what tax depreciation is. So it's conceptually not a hard calculation, but I think practically it's going to be difficult for some taxpayers.
Right, and it goes back to the systems issues
Yeah.
and how do you kind of create the
Yeah.
process to track this separate CAMT.
Yeah, I think most companies would say they have issues with fixed assets generally,
Right.
just from
Under the normal
yes,
rules.
under the normal rules, because you're typically dealing with, you've got federal rules, you've got state rules,
Right.
you've got now QBI for purposes of computing like FDII or GILTI. So there's just a lot going on with depreciable assets.
Right. All right. So the last thing on the depreciation side, repairs. I know
Yep.
this is something that has caused a lot of questions.
Yep. So a lot of companies. So methods of accounting. You can choose multiple different methods of accounting on how you compute taxable income. A lot of taxpayers choose a more favorable method with respect to their repairs and maintenance expenses. So they determine if it doesn't yield a improvement under the tax law, you can deduct the repair and maintenance expenditures as you pay or incur them. For book purposes, sometimes those repair and maintenance expenditures may actually give rise to a book asset because the standards are not identical for GAAP and tax. So the guidance clarified that if you deduct repairs under this more favorable tax method, but have a book asset, that neither the book asset nor the tax deduction for repairs are taken into account in computing the depreciation AFSI adjustment. And that was something taxpayers were looking for a benefit there because they wanted to get the benefit of,
Sure.
of the cost that they effectively did depreciate. They just took the depreciation faster.
Got it.
Is what their view was.
All right. So let's move away from depreciation, head into what we're just going to
Yes.
kind of hodgepodge of M&A and reorg considerations.
Yep.
So let's start first with, and this is something obviously I do a lot to deal work, the non-recognition transactions. Yep. What did the notice tell us about non-recognition transactions?
Yep. So the notice effectively said there are going to be a number of non-recognition transactions that give rise to book gain or loss. So the notice basically said if you have a transaction that would be non-taxable, that is non-taxable, so think your 332 liquidations, 351s, 721s, reorgs.
Right.
So if you have one of those, it is not treated as resulting in any gain or loss from a book perspective. So book has income or loss attributable to a transaction such as that, it gets reversed. So you don't take it into account, which is good news.
Right.
I think there was comment letters out there that said, hey, I'm undergoing a split off.
Right.
And a split off gives rise to book income, but it's a non-taxable transaction. Right. So I shouldn't have to have a CAMT liability on a non-taxable transaction. And IRS and Treasury effectively said, yeah, I think we agree there. The corollary there is that if you don't get so typically if you have a book income, you might also have book basis that gets created as a result of that transaction. Here's another tracking nightmare, but the notice says you have to reduce that book basis back down to what it was pre-transaction. So you don't have to pick up the book income, but you also don't get the benefit or you don't have to take into account the book change in basis.
Right, and this is again another similar kind of issue that taxpayers have to face with Pillar 2 is sort of tracking this basis and kind of ignoring, necessarily the book basis or making an adjustment for that.
Yeah.
So a tracking nightmare is probably well stated.
Yeah, and don't stop there, because not only do you have to track it, again, no transition rule here. So,
right,
so you might have had transactions that occurred before a CAMT was even contemplated.
Decades ago.
Decades ago. And you have to kind of, to the extent you still have those assets on hand,
right,
you have to kind of trace back. So I'm not sure if that was intentional or if companies will comment on that, but it is something that I think people were thinking that they had some amortization from, so amortization doesn't have an adjustment. So what's typically running through your book income is permitted as a reduction to AFSI. So people have, potentially amortization from non-taxable transactions that they were thinking sheltered their CAMT liability.
Right.
But they might not have that anymore given this rule, because they might have created some basis out of a non-taxable transaction that they don't actually get to reduce AFSI by.
Right. One thing I will note on the non-recognition transactions for listeners is that there is a special rule for what they refer to as component transactions. And so if as part of, like, for example, a split off or spin off or whatever, there were some taxable income that was recognized as part of as a component to that overall plan, for example, under 357C or, boot in a reorg or whatever, those amounts are included. So you do actually kind of have to go through all the various components, and any taxable piece is included in that AFSI.
Yeah, so your 100-page step plan, you got to...
Right, you gotta go through step by step and figure out where that tax is. All right, so let's cover a couple other areas. Consolidated groups. There were some special rules for consolidated groups.
Yep, so the statute, and I think this is how some people were reading it already, but the notice just basically in one sentence says, this is a consolidated group liability. It is not a sub-by-sub liability, which then creates a whole nother set of issues that, do you have CAMT attributes that, like, when you spin off a company or when you sell a sub, like, what happens with potentially, like, if there's a credit that was created, who gets the credit? Does it stay with the consolidated group? Does it get allocated partially to the sub? So it's going to be, I mean, these are things that probably will be contemplated at some point, but aren't.
Yeah, no, great point. What about, there were some special rules on COD, on cancellation of indebtedness income, which, given our current environment and potential recessionary environment, may be more applicable for more companies than they had hoped.
Yeah, and I think this is a taxpayer favorable rule, and it basically, similar to the non-recognition rule, it basically says if it would be excluded CODI under Section 108, but it gives rise to book income or book gain, you don't have to pick up that book gain. What's similar to 108 is that they talk about, when you reduce attributes as a result of excluding CODI under 108, the notice contemplates reducing CAMT attributes, but doesn't say what CAMT attributes are. So presumably it's, there's a separate FTC regime that might have a carry forward. There's a separate, there's financial statement NOLs that might get reduced. There's obviously the CAMT credit that might get reduced, but the notice contemplates a reduction of attributes, but does not say what those attributes are or the ordering of how you would reduce the attributes.
So it might be something to comment on.
Yes.
Hopefully get some additional information when we get those proposed regs. All right, let's talk briefly about partnerships. Okay. What did the notice tell us about partnerships?
Yep, so I'll lay out first that there's a special rule with respect to partnerships. So when a corporation owns an interest in a partnership, the general rule is that you have to know, and this is really difficult, but you have to know the partnership's AFSI. So the partnership needs to compute its AFSI in and of itself using the same adjustments that a corporation has to. But then the corporation only picks up its distributive share of the partnership's AFSI. So notice does not define what distributive share is, by the way, and that's a huge open item for a lot of our sub-K colleagues that are looking for guidance on how to apply these rules. But the normal rule is you only pick up your distributive share of the lower lower tier partnership. What the rules under, when determining whether you are an applicable corporation and determining the AFSI of kind of the corporation, the rules say not only do I have to pick up that corporation's AFSI, I also have to pick up anybody that's related or is treated as a single employer under Section 52A and 52B. And these are really nuanced rules, but they basically say if you own greater than 50% of something, you pick up 100% of their AFSI as well. And then they say you disregard two rules. And in determining this, the AFSI, you disregard two rules. The two rules you disregard are this partnership distributive share rule and a rule relating to pensions, which we're not going to talk about. And commenters were wondering, well, is that rule there so that I don't, in a situation where I aggregate my partnership, is that rule there so that I don't pick up more than 100% of the partnership? So like I would pick up under 52A or 52B, 100% of the partnership. Mm-hmm. And then is that rule getting turned off so that I don't pick up like also my distributive share to have like, say 115% of the partnership?
Right.
That wouldn't make sense.
No.
So a lot of commenters read it as, oh, it's just there when you aggregate. The notice says no. You turn that distributive share rule off in all circumstances, whether or not you aggregate that partnership under 52B. And that creates kind of it clarifies the rule and it makes it relatively clear now. But what it does is it creates a kind of issue in some circumstances where you have gap consolidation where you might not expect it. And then one of the situations is anybody that underwent an Up-C.
Yeah.
If they went public kind of through a partnership. What happens is typically the public company, when it goes public, all it owns is an interest in a partnership. And it's usually a minority interest,
right,
well below 50%. The US gap consolidation rules say, well, because you control that partnership, we're going to make you consolidate. So if you ever look at one of an Up-C, kind of a company in an Up-C structure, you'll see a really big net income number, and then you'll have a really large reduction to net income for non-controlling interest. Right. And then you come back to just net income attributable to your controlling interest. But the rules are very explicit that they say you take the net income line from the 10K or the financial statements, and that is the 100% of the partnership. Mm-hmm. So a lot of the Up-C kind of taxpayers are concerned with, I'm not that big. I'm nowhere near $1 billion. But if you pick up 100% of the partnership, I might be.
Right.
So I think that's something that probably will be commented on. I don't think it's the right conceptual answer to be able to have to pick up 100% of the partnership, but it's definitely kind of, I see the question floating around in a lot of circles.
An important trap for the unwary, and particularly for those that may think that, those public companies that may think they're below the threshold because they have this minority interest, and they may actually need to include all of it for purposes of computing their CAMT income.
Yeah.
All right, so want to spend, because this is the Cross-Border Tax Talks podcast, on some of the international tax issues. And there are a number, right? And we haven't seen any guidance on this. So hopefully we'll, some of the next interim guidance. Really, the two big issues, Jason, frankly, that I've been seeing in the international space is the first is the issue on the double taxation of dividends. Just the way the mechanics of those calculations work is you're picking up the income of the foreign subsidiary, and then if you make any distributions, you're also including that. So it's really a double counting under kind of a strict reading of the statute. I think the hope for many of us is that will get fixed. How they do that adjustment, I'm not sure. That is certainly one of the issues. Another one of the issues that I've seen is related to foreign tax credits. In many cases, a U.S. company, a company's U.S. tax year may differ from the tax year of the local jurisdiction, right? Because they need to keep a calendar year, and maybe in the U.S. it's a fiscal year. And so the determination of how those foreign tax credits work for purposes of the CAMT, another open issue. And again, that is just an example of two of long ones. And then I think maybe the last thing to mention, which we already covered briefly, is that I still get the question: is this CAMT, the book minimum tax, which is based on book income, which is a 15% tax? Is this a Pillar 2 income inclusion rule kind of qualified tax? And The very short answer is no, it's not. It's the adjustments are different. Yes, we start with financial statement income. The underlying adjustments are different, but I think what really differentiates it is how it treats foreign, the non-U.S. earnings below, and that it does aggregate all of those. It's not separate country, and again, just an entirely different set of rules, which means that taxpayers who meet the revenue thresholds for both the CAMT and the Pillar 2 are going to need to set up those separate books with the adjustments that you've talked about, with the adjustments for Pillar 2 that I talked about on the last podcast. So just a lot of complexity for taxpayers to deal with. So maybe if we then move on to, and we talked about it a little bit earlier, what future guidance is left? And I assume, Jason, that, and I think maybe the Treasury had already acknowledged, we'll likely get some more interim guidance before we actually see proposed regs.
I would think so. Yeah, no, and I think they're kind of taking it in tranches, and what they take on, and I think, like I said, they covered most of the big stuff. And the good thing is now we have reliance. Like, companies have something to rely on in the meantime.
Right, because the notice, great point, can be relied upon.
Yeah, we saw, like, back in TCJA days, we saw a lot of FAQs. And I know taxpayers don't like, FAQs as much because it does not give them the reliance. So at least now there are still a lot of gaps. And I think we still have time before this kind of kicks online, but I think companies are starting to disclose some stuff in their financial statements about this as well. So I think this definitely, there's a lot of gaps left. So we might still have to take reasonable interpretations of the statute and what we have so far.
All right. So maybe in closing then, Jason, what advice do you have for taxpayers and advisors, for that matter, related to the CAMT?
Yeah, so I think commenting is really important, and I think the key thing here is that the government, is doing a great job. They have multidisciplinary folks on this. Yeah. They have just like the firm has multidisciplinary. They have a lot of people hands on deck, but they're not seeing the kind of on the ground issues like we are. So it's definitely good to comment. I think you got, from the date of this notice, there were 60 days. I think we're looking at March 20th, 2023 to submit comments. They've asked for a whole litany of things that they want comments on, but they're also open to whatever comes to folks' minds.
Right.
So it definitely has helped, because I think there's been comments, you kind of see direct results of the comments from the first round that went into this guidance. So I think they're definitely listening, and they're definitely willing that they want to hear from taxpayers.
Good. Well, I think getting engaged in the process is always important. Yeah. So, Jason, great having you on. Always interesting. Thank you very much.
Thank you.
All right. Well, thanks for tuning in to this week's episode of Cross-Border Tax Talks. Thank you, Jason Black, a partner in PwC's Washington National Tax Services practice. I'm Doug McHoney, PwC's International Tax Services Global Leader. Stay tuned in 2 weeks for another exciting edition of the Cross-Border Tax Talks podcast.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.